Assalamu alaikum. Welcome to part 2 of the AFM paper, which is March June 2022. This is question number 2, the risk management. In part 1, we went through the investment appraisal question, the net present value of this question, of this paper, which was for 50 marks. Now we are going through a currency risk management question worth 25 marks. So requirement number A, recommend on financial terms a hedging strategy of this payment. Okay. B, evaluate the results of the 3 hedging instruments from exhibit 2 and explain what is meant by basis and basis risk. So first we are going to go through exhibit 1. Okay. We'll zoom it. So this is an American company with a centralized treasury function based in US. Okay. And they want to hedge a payment of this much, 18.25 million from a German supplier. It is due to make on 1st of August. I don't know whether you can see it or not. We'll zoom it out. Date is very important. So spot rate has been given, 5-month forward has been given, future has been given, option has been given. So you have to decide basically which. In option you have to select, in others you don't have to select, they are already given. So you have been given 3: forward, future, option. You have to decide whether you have to go for call and put option and the date, March, June or September. Okay. So now, this question is often the easiest. Okay. So you have to do it in spreadsheet, the calculation question. Let's go by the forward first. Okay. In forward also you have to decide which rate, the first rate or the second rate. You have to decide which rate to choose. Okay. For that, see, this is in euro, right? This is in euro. And if you see the exchange rate, it is quoted as US dollar per euro. That means it is quoted in euro. Okay. So that means you have to deal in euros. Okay. Always check in which currency it is quoted. Look at the base currency. It's in euro. Okay. So you can only deal in euro. You have to buy or sell in euro to the bank. Okay. This is a payment. That means you have to buy euro. Okay. You have to buy euro means you have to buy euro at this rate, higher rate. Because in my lectures, I always told you, bank is the one that is going to get the profit. You will be at the worst position. You will buy at a higher price and you will sell at a lower price. Okay, so you will sell at a higher price, that is 1.544. So this is the rate that you have choose. You can even highlight the rate also if you want. Okay, for future nothing, it is September future. Okay, due to make on 1st and today is 1st of March. Today is 1st of March. So if you see from March to August, it's for 5 months. Okay, and based on this, tell me which option are they choosing, March, June or September? Looking at future, automatically you can say, but think it is September because this is the next one. From 1st of August, if you have to see, okay, the closest to the expire is September because March and June are already expired. So September option they have to go for, whether call or put option. Tell me. See, for this also check, it is priced in euro and you have to buy euro because it's a payment. So you have to buy euro. Yes, you have to buy euro. That means it's a call option because call means option for buying. Put means option for selling. So you will go for call and you will go for a September. So call September option you will go for. Exercise price is given and they are told that assume option will be exercised and this is the premium 0.69 basis. Contract size for both will be 125,000. Okay. Now, starting with this one, decide whether you are going to multiply or divide. Decide here itself. Before jumping to the Excel, decide here itself. You are going to divide your 18.25 million by this or multiply. For that, check. This is 18,250, and if you see this price, it's $1.1544 per 1 euro. So you have to multiply, because this is in dollar, this is in euro, different currency, multiply. Okay. So here it's 2A. Okay. 2A. Forward contract. Okay. Start with forward because this is the often easiest and you can finish it off. Futures and options will take a little time, especially futures. Okay. I'm going to bold it out now. So here you are going to show. Okay. Or you can show any cell for that. We'll show it here, or here also you can show. Equal to forward contract. How much is the price? 18,250,000. 3 zeros. Multiply this rate by 1.1544. Enter. You see, this is in dollar now. You want everything in dollar at the end because you are a US firm. So this is in dollar. Okay. Keep it. Go to future. This also I'm going to make it bold. Okay. When you come to the future, you have to write what future you are buying. You are buying or selling future. You are buying because you want euro. Even future contract is in euro contract. I mean, the contract is in euro currency. So you have to buy. Buy. Here you don't have in euro. You have to go to symbol. Insert euro. Insert. Okay. Buy euro September future. Write the date also. And you have to say whether you are buying or selling that future. Now, after this, remember you have to find the basis risk because you want to find the closing future price. Without that, you cannot find profit or loss. You only have the opening future price. This future price which is given to you, 11560 is the opening. You have to find the closing. Okay. So, what is the price? Closing. Okay. Closing future price. Label it. Don't just write numbers. You have to write what you're doing. Closing future price you are doing. Okay. So this is the method that you do here. Equal to. Okay. There are two ways of doing this. But let's do the first one. What is it? That is spot minus your, or you can add your basis risk with your spot price. That also you can do. What is the spot price? See, spot is given here. Okay. Because you have chosen here in the forward, spot also it will be this rate. Because you are buying. So it's 1.1497. So with the spot, you add your basis risk. So your spot was 1.1497 plus basis risk. When you do basis risk, put it in bracket. Okay. Plus bracket. Okay. What is your opening future? 1.1560, right? 1.1560. From here, you minus your spot. Opening minus spot. Spot is 1.1497. With this, you multiply what? The fraction, unexpired basis. The okay. If you see here, it is on 1st of August, right? Basically not unexpired basis, expired basis you have to take, because this is the second method, the shortcut method you are using, that have been given in the exam years. Okay, so if you see from 1st of March till September, just count, it will expire at the end of September. March, April, May, June, July, August, September, 7 months. Out of 7 months, okay, 5 months. 1st of March to 1st of August, it's 5 months. Okay, so it has been using for 5 months out of the 7 months. Okay, enter. So this is the price, closing future price. This is how you get. There is another way of doing it, which normally we do. But anyway, let's, okay, this is the method. We'll just do it like this. Number of contracts. Okay, once you find the closing future price, we have to find the number of contracts. See, once you find the number of contracts in future, good thing is, because the contract size is same in future and option, and it will always be same in your AFM exam. So number of contract, once you calculate it for future, you can use it for options also. No need to calculate again. What will be the number of contract? Both are in same currency. Your payment 18 to 50,000. Divide by 125,000. That is the contract size. Enter. 146. Exactly 146 contract. Good for you. No under or over hedging. Now, what is the outcome? Outcome in the future. Just multiply your contract, number of your contract with the contract size and the closing future price. That's it. So your contract, number of contract is, contract size is 125,000. Wait, don't forget to put equal sign. 125,000 multiply by number of contract, multiply by your closing future price. That's the whole point. That's why we want a number of contracts and closing future price to get the outcome. Enter. Enter. So you see, this is in dollar. You can write here if you want that this is in dollar. So this is your payment in future. Now make sure that this is bold, so that it's easy for you to compare. This is also. So just compare which one is giving you low cost, the forward or the future. Future is giving you the low cost, right? Now let us go to options. So coming to option, you have to say that you are going to buy, same thing, buying euro, call euro September call options. You have to write it. If you don't write it, you are going to lose 1 mark. Number of contracts. 146. Just write it. Extra thing is premium you have to calculate in options. This is not there in options or forward. So premium, how do you calculate? Equal to this multiply by, okay, number of contract into contract size, okay, multiply by remember to multiply this with this 0.069 divided by 100, okay, always divided by 100 because it's in base is 0.69 because it is cents per US dollar. You want to convert it into dollar, so divided by 100. This is your premium in dollar. Okay, now the outcome, or you can leave one line and write outcome using option. What would it be? See option, what you have done for future, do exactly same thing for here. Number of contract into 125 the contract size. There you multiplied with the closing future price. Here you will multiply it with the exercise price because we assumed it will be exercised, which is 1.1540. Understanding? Because you have to convert it into dollar. It's not yet converted into dollar. This was in euro. Multiplying it with the exercise price will convert it into dollar. Enter. And with this, because it's a payment, add your premium. Just simply add your premium. Okay, premium is already here. So equal to sum function. Just take this too. Enter. This also you can make it bold. So now you can compare the three different costs. You see, the highest is option. Option is giving you the highest payment. That means that is the most expensive out of the three. So on the basis of the calculation, tell me what you will recommend. Forward, future or options? I will add the answer here. Future. But you write full sentence, okay? That on based on the calculation above, future will be chosen because, give reason. Because it gives the lowest payment. Future gives you the lowest payment. Write it. You will get one additional mark for writing it. Now we are coming to part B. Part B, you can write it in Word. Okay, what is it part B? What should you do in part B? Evaluate the impact of the results using this one. If the rates and the future prices changes, you have to open this exhibit 2 now. So if you see exhibit 2, prices are changed. Everything remains the same. But here, this is scenario 1, this is scenario 2. Okay. So based on this, evaluate. What should you do? Should you go and change the figure and then tell? No. Don't touch what you have done in part A. Don't touch it. You will just tell what is the impact of these changes on that result. That's it you have to explain. So let's start with the forward. For scenario 1, okay, you have to write it here. Mention which scenario you're talking about. Labeling very clearly is a must. Okay, this is scenario 1. Using forward. Tell me. Open one and keep both together. Keep them both together like this. And see the forward. 1.1497 and this was spot at 1st August 1.1534. Will it have an impact? First of all, understand whether it will have an impact also or not. Sometimes it might not have an impact. Sometimes it might have positive, sometimes negative. There are three different choices. Regarding forward, okay, let me tell you, there is no impact. There's no impact on this. The result of the forward contract would be same in part A. Why? Because the 5-month forward trade, this is for September. Sorry, this is for August, is irrelevant. Forward rates are set in the beginning, that is 1st of March. You do not need the forward rate in August. Forward rate does not change. One rate decided today remains fixed. So the answer for this would be forward, same as part A. Even for scenario 2, okay? Even for scenario 2, forward will remain same. No impact in the forward. Okay, forward same as part A. You can just copy paste it like this without wasting time writing again. Make sure that this is bold. Okay. Now, coming to futures. You can do simultaneous, you can do together also both, which saves the time, okay? Futures. You have to write why it is irrelevant, why it is same, because forward rate in August is irrelevant, okay? The 5-month forward rate on 1st of August is not relevant, as it would relate to contract that is maturing on 1st of Jan. What about future? See, first find out the basis risk of both. If you see the basis risk, this, okay, future minus what? The spot, okay? This 1560 minus what? The spot. Where is that? Wait. Wait. I'll zoom this out. Okay. So here, if you compare the spot, this is the future price, right? 1552 minus this spot. Okay. If you compare this and this minus, the difference is 18 basis point. And if you originally go here, 1560, and compare it with the spot, this one, it is, why is it compared with 1152? I think it is compared with the closing future price, that's why. Yes, it is compared with the closing future price. So that opening is compared with this closing future price, and here, because already this spot is at 1st August, that means closing future price only. So here this is compared with this. So if you see the difference, it is 18 basis points. Should I write it for you? I think it's confusing. I'll better write it for you. Okay. Future. First we'll finish with this. Future. Basis risk in A is 18 basis point. How? The opening future minus closing future. Opening was 1.1560 minus closing, that is 1. See, once you got the closing future price, you don't have to take it with the spot, okay? One 1.1542. Future risk in part A is 18 basis point, and here also it's 18 basis point. How? The new future price, that is 1.1552. Under scenario 1, this is the opening future price. No need to find the closing future price, take with the spot, because that is the spot for the August. 1.534. So you see the difference is same. That means here also future is same. There is no impact because the basis risk is same. Coming to the option. What about option? The result of the option calculation would change as the option would not be exercised. See, we'll see here. Okay, coming to here. Okay, they have not given, but using the future you can tell that options will not be exercised in this case. Okay, so the result of the option calculation would change as the option would not be exercised. Because they have not even mentioned about anything about option. So let's assume option will not be exercised. But because these prices are changing, future prices are changing, option also will change. Okay. Now coming to second scenario. Okay, I will be going a little quick because we have other parts also to do. Scenario 2, forward will not change. Okay. What about the future? Future will change because now the basis risk are not same. But option will remain the same as part A. Why? Options would be exercised as the spot rate is greater than the exercise price. So when you have to see the exercise price with the option spot. This was the spot. Okay. If you compare this with part A, the exercise price was 1.1540. So you see your exercise price is less. Sorry, your this thing is less. Here the spot trade price is less than the exercise price. That means you will not exercise the option in scenario 1. But here in scenario 2, your spot rate is more than the exercise price. So you will exercise the option. That's why, because you will exercise the option, it will be same as part A. Only your future will change in second scenario. How? Just calculate the basis risk. Okay. So the expected gap between the spot and the future would be, look at the contract size, 63. Okay, this minus this 49. 14 basis point in scenario 2. Okay. But in your part A, we already calculated 18 basis points. So 18 and 14. That's why it's different. So what would be the result of the hedge then? there's a difference by 4 basis point. It will become 4 point less efficient. So here, because 18 and 14, okay. So when you have to take it in terms of 4 basis point, okay. So 0.4 basis point. 146, okay, multiply by the contract size and 4 basis point, 0.004. I think there are 3 zeros, 4. What is the result? 7,300. So you have to add this with the result of the hedge, the 7,300. You have already got it in the future. Just go to part A, open your spreadsheet. This was the outcome. With this, you have to add that 7,300 also. Why? Because here it is less effective. You are hedging less here. Okay. So you have to show that impact. That means according to scenario 2, you will be in a worse position. Now what else? Part C. So we are done with it. Coming to part C. In part C, what should you do? Explain what is meant by basis and basis risk. Okay. So I'm not writing the answer, but you can write it on your own. Okay. Basis means the difference between the future and the spot rate. Okay. And the basis risk means the risk that the spot rate will not have a predictable relationship with the future price. So now we'll talk about how it is linked to part A and B. You can talk about assumption. They have already assumed that basis will diminish at 0 and all those things you can write. Okay. So you can see that in 1st August, you had 18 basis point. But in the second part of scenario, okay, you only had 14 basis point. That means it is less effective. The hedging was not done effectively, right? Which led to greater cost. So this shows that they do not follow a linear fashion. Basis does not reduce in a linear fashion. Okay. So because of this, what is the negative side of this? The consequence of this basis risk is that your net payment will not be fixed, or you cannot even predict also using future contract. Especially in the second part of B, the second scenario tells that, right? Because you have chosen future, remember in part A, based on assuming basis risk. So if you go by that, you are incorrectly choosing it, the future. But if you go forward are not subject to basis risk. Learn to compare. You have used forward and option. Learn to compare it. Obviously, no use of comparing it with option because it is giving the highest, but you can choose with the second best, that is forward. So compare future with forward, saying that forward does not have basis risk, right? Because it will give you the best result. However, the financial consequences of basis risk are still likely to be smaller than the possible losses if the payment was not hedged. It is still better to hedge using future than not to hedge it at all because the losses are very small. Okay, coming to part D, the last part. This is mostly asked in risk management. So be prepared for this, treasury department. Explain the reasons why local treasury functions may be established in countries where they operate for 6 marks. 6 points you have to give. 6 points means, let's say you have to give 3 points. If you elaborate on these 3 points, 3 into 2, 1 for identifying the point, 1 for explaining that point. So 3 points you have to give. Why they want to set up treasury function and where they operate. I will give you the points. You elaborate it on it. One is local operational needs. This comes in one. Under this subheading, you can write explain it. Second point is financing requirement. Third is regulatory and tax condition. So these are the 3 points. Let me explain you these 3 points. Local operation needs means what? See, if you're having an operational need in a particular country, okay, it is better to have treasury function in that area because they will understand local needs better than having one centralized treasury in another country, isn't it? So for local operational needs, okay, having the treasury departments in local, like decentralized, you can say another word is that they know more about the local needs. So this will help in terms of driving down cost. Okay, coming to the next, financing requirement. Okay, for example, you sometimes might want to use internal hedging. You might want to net off your assets with liabilities. So in that way, having local treasury function is more helpful because they have more knowledge of the local environment, local financing issue. They know about the local interest rate than having one centralized treasury department. And the last is regulatory and tax condition. Okay, local experts, they have better knowledge of this regulatory and tax advantage. Hence, it can drive down your tax cost and also all legal rules and all. Especially if the rules and regulations of your country is totally different to the foreign country, having a local expertise there is beneficial. Now we'll be moving to question number 3. Okay, you can close all. Go to next. So this will be done in the next part 3. So watch my part 3 for the third question of this, and part 1 I've explained the net present value question. Thank you for watching, and don't forget to subscribe to my channel if you have not yet subscribed, and best of luck for your AFM exam.